Hello. In this video, we'll talk about one of the most sacred of all deductions, even most sacred of all provisions in the entire Internal Revenue Code, the Charitable Contribution Deduction. Now, this is something that even before you've probably learned about tax, you might have heard about. We've heard about giving to charities and how that potentially could provide a tax benefit. So whenever you think of the word sacred, you might think of something. I think of a sacred cow. There's various provisions in the Internal Revenue Code that have sacred elements, meaning that throughout time, throughout history, since we've had our income tax, Congress has said for various reasons, social policy usually, that these provisions should stay. And this is one of them. The charitable contribution deduction is something that whenever Congress talks about changing the tax law, this is something that always remains, okay, this will stay. You might have heard about flat tax. The charitable contribution deduction is something that even people that think about having a simple flat tax, they can't get the argument around how we can get rid of this deduction, because if you have a flat tax, you're going to have to get rid of many of the deductions. Now, I'll talk later about the social policy and whether you might agree or disagree with the charitable contribution deduction. But first, I want to go through and talk about the specific application. So, we're talking about the charitable contribution deduction, and again, as I mentioned, this is something that has been throughout the history of the income tax. The first item we have to look at is that the amount of the contribution has to go to a qualified recipient. You need to have a qualified recipient. What exactly does qualified recipient mean? Well, this is something that's defined by the Internal Revenue Code. Now, you probably have in your mind what exactly a qualified recipient means. It's an organization that has charitable functions. We're talking about things like churches, hospitals, educational institutions, various organizations, as I said, that provide charitable endeavors, which help society, and even nonprofit foundations. Private foundations even can be grouped in that. And that's where you see a lot of wealthy people creating nonprofit private foundations that are used to, again, benefit society through charitable endeavors. And when they do this, they create these various charities that provide these benefits, and lots of argument come up of whether they should actually get some type of tax deduction for this item. That's something that we're not going to go into the specifics of whether those charities, whether they actually do provide benefit or they provide most benefit for the wealthy individual that sets them up. You might think about the Bill Gates Foundation or other foundations out there. That's something to discuss in a different video. We're going to assume that for this discussion that they are going to be a qualified recipient. Again, qualified recipient really does change. Tax-exempt organizations as well as qualified recipients, qualified charities, that is an issue that we could have many videos on. So we're just going to think about the very plain vanilla, again, situations: a church, a hospital, a educational institution, Goodwill, the United Way, various organizations that provide charitable endeavors. So we have our contribution, we've presented it, or we've given it to the qualified recipient. Now the next requirement is there cannot be a quid pro quo. So the phrase quid pro quo comes from Latin, and it means this for that. So really what it means is, are there any strings attached? Are there any strings attached to the contribution where the person or entity that is contributing is going to get some benefit? If there's any quid pro quo, then that amount cannot be deducted. Now, it's possible to have a contribution that partially is a quid pro quo and partially non-quid pro quo. Again, we have to have non-quid pro quo to have a deduction. So some examples you might have been to. Maybe you've been to a charitable organization that had an auction, and they have some crazy prizes that you can auction for. Maybe a painting. or a vacation. And if you're getting any benefit, you have to determine the fair market value of that benefit and subtract it away from the amount that you actually bid when you win the item in the auction. That's subtracted out. So fair market value is subtracted. The difference can be used as an amount that can be potentially deducted as a charitable contribution. So let's just take a simple example. Let's say that your favorite football team at one of these charitable auctions, there's 2 tickets to a game. And let's say the fair market value of those tickets, if you bought them, again, willing buyer, willing seller, is $100. Well, you bid $150 at this charity, and you get the tickets. You subtract away the fair market value of the tickets, which is $100. So $150 is what you're paying, minus $100 fair market value. So $50, the difference, is considered the contribution that can go further. The $100 fair market value stops. The fair market value stops. It cannot be deducted. See that? And you can obviously analogize that and use that same rule for other types of situations. So once we've determined it's a qualified recipient, and once we've determined that there's no quid pro quo for the amount in question, again, you can have partial, the next question becomes, what is the type of contribution involved? What is the type of contribution involved? So there's really 3 different types or categories of contributions. There's cash, property, and services. I first want to talk about services. So services, maybe you're providing some type of accounting or tax service for a charitable organization. Again, to help society. So for example, many CPAs provide free tax preparation service through the Volunteer Income Tax Assistance Program. The Volunteer Income Tax Assistance Program is sponsored by the IRS and various organizations like the United Way or other types of charities. That service you're providing, can that be deducted as a charitable contribution? The answer is no. No services can be deducted. No services can be deducted as a charitable contribution. So services, we stop. You can't deduct them. All right? So let me put an X here to make it even more clear, put an X there. Now, if you have services and you also buy some property or you provide some cash or even things as simple as indirect cash or property, like you drive somewhere or buy supplies, that can be considered cash or property. So when you have services, sometimes it can go even farther than only considering the service at issue. It can be cash or property as well. Cash is pretty simple. You're making a cash contribution to the charity. So your church, you give in the offering of your church. That's simply cash. Property is the most difficult of all. All right? Property is difficult because depending on the type of property, there's different limitations. So when it comes to cash, there's going to be limits. And I'm going to talk about limits in a moment. But I want to mention that with property, you have to look at the character of the property contributed. And there's going to be characterization videos that you can watch to determine whether it's capital or ordinary, long-term capital, short-term capital, certain types of characterization property. There's different limitations. Now, with cash, the limits are very broad. They're as generous as possible. With property, there was lots of abuse going on where individuals had, for example, capital assets like stock, like investment stock, and they would buy the stock for real cheap. And then 10 years later, the stock would skyrocket in value, and they were getting fair market value property. So we use fair market value when we look at property. The amount of the contribution could be considered fair market value or could be adjusted basis, depending on the type of property. So they were using that property that skyrocketed in value, and then guess what? They weren't having to recognize gain by selling it because they're not selling it, they're contributing. Now there's special rules, anti-abuse rules that have changed over time. I'm not going to go into those because they've changed. At the time of this video, it's potentially possible you could have to recognize gain when you contribute. Or simply you just get the benefit of the fair market value or adjusted basis. The limits at the time of this video are based on adjusted gross income. For cash, 50% of adjusted gross income. For property, could be 30%, 20%, 50%, depends. Now, I'm not going to tell you those rules specifically. I'm just telling you what they are at the time of the video because they can change over time. The limitations are severe when it comes to charitable contributions, and it also is a function of who you're contributing to. Is it a plain vanilla charitable organization like a church or educational institution? Or is it some type of private foundation? Very interesting issues. Very interesting issues. Now, one thing to note is that if you cannot deduct your charitable contribution, it can be carried forward in the future. And at the time of this video, it's 5 years. So you potentially could lose it in the future. That can change again in the future, so don't be wed to that rule. You need to look at the rules when you're watching the video with respect to what is the application when you're watching. So please look at that. But I'm just bringing attention that there can be rules on carryover. You could potentially carry over any amount, carryover potential. So potential carryover. And again, it's changed over the years, so please look at what it is when you're looking at this video. So that's really the basics of the charitable contribution. Now I want to talk about history, social policy, standard deduction effect, and interesting issues that are involved. And we're going to talk about all of these things with that. So the history of the charitable deduction, it's been around for a long time. And as I mentioned at the beginning of this video, it's a sacred cow. It's one of those provisions that regardless when certain politicians come into power and they want to revamp the entire Internal Revenue Code because it's just too complex, guess what happens? Well, if we want to make something simple, we got to get rid of all the deductions and credits and loopholes and income rules and everything out there that makes tax complex, right? But they never want to get rid of charitable deduction. Why is that? And that has to do with social policy. The social policy, isn't it good to help out other organizations that help society? Yes, it is. It is good. It's good to give back to society and to help others. And there's various, obviously, moral implications here, ethical implications, but even just from a social standpoint, helping others, okay? Helping others. And there's all sorts of, issues of government involved. I'm not going to go into those because that's not, we're just talking about the tax implications. But think about it. If you have welfare and other programs where governments provide for low-income individuals to help them out, having these types of voluntary programs where you're helping out society and these lower income individuals and certain groups, it really does help. It really does help because it doesn't put a burden on the government. So it's really a win-win for all different types of people, especially when there's a tax deduction. So we want to encourage giving to charitable organizations, and that's why we have this deduction, and that's why it's so sacred. Another thing that's interesting is, at the time of this video, the estate tax is in place. When you're watching it, it might be gone. But one thing to note is that, and this is an interesting issue that I'm going to bring up here in social policy, is that the estate tax, which is a tax on your wealth at death, there's a deduction for any charitable giving that you've given to get out of your estate. So it incentivizes very wealthy individuals to make very large contributions at the end of their life to get it out of their estate, so it's not taxed on it. So you potentially can save, let's say the tax rate is, the ordinary income tax rate is 40%. You're in that bracket. You're in the highest bracket of 40%. Okay, let's just say, again, these tax brackets can change. I'm just using 40% as an example. That's for the income tax. So if you give $100,000 and you're in the highest bracket, you could save $40,000 in terms of your taxable income. In terms of your taxes. It lowers your taxable income by $100,000, and then $100,000 times 40% is $40,000. So you potentially can save $40,000 in your income taxes. The estate tax, if you're very wealthy, can be another 40%. I'm just making up a number. So you potentially can not only would save $40,000 on your income tax return, but another $40,000 on your estate tax return. So you gave $100,000 and you saved $80,000. That's if you're subject to both the income and estate tax. Now, not a lot of people are subject to the estate tax. Again, if it's out there, at the time of this video, it is relevant, but it might not be in the future. So just hold that. And I'm just bringing this up because it is a history discussion. 80%. You can get an 80% benefit. And then you also, again, it's a moral and ethical or a moral ethical discussion of whether, wealthy should be helping out these societies, you might think, well, no, I shouldn't have to help out because, I earn my money. Well, again, there's certain benefits for helping society. It helps out the economy, or not the economy, but it helps out our society, which can help you indirectly in certain ways. Again, putting less pressure on government, and again, indirectly can affect things. And there's all sorts of arguments. I don't want to go into those. So we've talked about history and social policy. And I think I've done a pretty good basic job. Well, it's a basic distinction of why it's so sacred. It has social implications. We want to encourage those to give. And you see the benefit when you not only couple it with the income tax effect, but the estate tax effect, which at one time was huge. So there's lots of giving. And in 2010, we had 1 year where the estate tax went away. So in 2009, the estate tax was there. In 2010, it was gone. In 2011, it came back. Guess what happened? There was lots of research done that when this happens, charitable contributions would go down with respect to the estate tax. Guess what happened in 2010? They were exactly right. So they had the facts back it up. 35% decrease in the amount of charitable giving based on estate tax numbers. It reduced by 35%. All right, so now I want to talk about the effect of the standard deduction. So one of the things that's always talked about is, again, simplifying taxes by increasing the standard deduction, which again, as I've talked about before, the standard deduction is, okay, every individual has some basic necessities in life where they should just get a standard amount to deduct. It's just an estimate. I know it's not very accurate, especially, given that doesn't increase or decrease based on your income, which it should. That's an argument for another discussion, but that's what some people have argued. It's a set amount. If we increase the standard deduction, many people will not be able to itemize if we still have itemized deductions. And by increasing the standard deduction, if somebody knows that they're going to not be itemizing because they're nowhere near the itemization amount, remember, itemized versus standard, you get the greater. You pick the greater of the standard and the itemized deduction. Let's say that all of your itemized deductions for a year. Now, we're not going to look at what the law is when you're watching this video, or when I'm discussing this video, or when I'm discussing this material in the video. But let's just say that all the itemized deductions that you have, not including charitable contribution, let's just say are $10,000. $10,000. That's the itemized deduction amount. And that's after, let's say that's after all the limits and stuff. That's before the charitable contribution. Before charitable. That's before the charitable amount. Let's say the standard deduction for a year is $25,000. Let's say you only make $60,000. That's your wages for the year, and that's the only income you have, $60,000. In order to get the benefit of the itemized deduction, again, we've looked at our itemized deductions, every other itemized deduction except charitable, and this is after the limitations and stuff. So now we're looking at charitable. You would have to make at least $15,000 of contributions. You'd have to give at least $15,000 of contributions. You'd have to do greater than $15,000 in contributions. If your income for the year is $60,000, that is 25% of your income. Are you going to give 25% of your income to a charity? Probably not. Some individuals might, because they're all about helping society. But that's probably less than 0.0001% of the population. I know it's sad to say, but that's just human nature. Some individuals, they give 10% to their churches, and they might give more items. But that's very important, okay? That's very, very, very important. You have to give at least $15,000. I'm sorry, more than $15,000. At $15,000, you're at $25,000. See what I'm saying here? Until you get $25,001, you're not going to be able to use the itemized deduction. You're not going to get any benefit. Because the standard for you, again, these are just hypothetical numbers I've made up, is $25,000 here. So you need at least $15,001 or more before you actually get benefit of itemized deductions. This is a huge issue. If we increase our standard deduction based on what it is, whatever year you're looking at, because this is something that, to make it more simple, people say, let's just increase the standard deduction and get rid of all these various itemized deductions, except for charitable contributions, mortgage interest, the sacred cows, and some other ones, right? The sacred cows, the ones that aren't very likely to go away because of the benefit. Well, that will really hurt the charitable organizations in society. They will take a huge hit. Now some people would still give, based again on moral, ethical, religious reasons, but some people might not. They might be dissuaded from actually giving. They might have gave the year before when they got the benefit of the itemized deduction. We increased the standard deduction, and now they can't get it. This is a huge issue to consider, so please consider this. Very important. Think about this. Think about it. It's big. Now, if you're very wealthy, it's not as much of an issue, but your itemized deductions could still be limited. So the last thing I want to talk about is some interesting issues. And when we talk about interesting issues, I just want to go through each of these. So the first thing with an interesting issue is we mentioned with the qualified recipients, there's these things like private foundations that are interesting. And again, certain benefits, so very wealthy people might have a private foundation like Bill Gates, and they put their name on it, and it might help outside areas of business for them. So they might be able to deduct the full thing because they call it a qualified recipient, non-quid pro quo type of contribution, and they're giving cash or property, right? But you can argue, hey, by Bill Gates having this foundation, people might say, hey, I want to do business with Bill Gates. So this kind of goes to the quid pro quo. It's like an indirect quid pro quo. It's something you can argue. Another example is if you've ever been on a university campus, you may have seen lots of buildings with names on them. It's guaranteed, well, I shouldn't say guaranteed, it's very, very, very likely that those buildings that are named, there was a donation associated with that. Or even just a college of business, college of law is named after someone, a donation. Can you deduct that full $20, $50 million donation by getting your name on it? Don't you get some benefit? Well, the question becomes, how do you determine fair market value? And that's really what the issue is. I would argue that yes, there is benefit because again, you have your name on the building. You have your name, the Nathan Wadlinger College of Law. My name's on the building. My name's on the College of Law. My name's on the College of Law. And I think that could potentially affect my business. It could potentially affect other things out there. It could give me some type of benefit. But the question becomes, how do you value that, which is always an issue in tax. Another thing involves, again, we talked about different types of property. All right, different types of property. How do you distinguish cash, property, services? I talked to that you can have services with some property you contribute as well. It's really important to focus in that, as I mentioned earlier, that if you contribute certain property versus other property, you deduct the fair market value versus the adjusted basis, or there's different limits, 20% AGI versus 30% AGI. That's very, very, very important. And that's something you need to know. And then what about this potential carryover issue? The potential carryover issue, again, at the time of this video, you can only carry forward 5 years. But is it really fair to limit to 5 years? What if you've given deductions in year 0 when you had a good year, but then the economy goes down for many years, and guess what? Every year after year 0, year 1, 2, 3, 4, you have losses on your tax return, and you can't deduct this because there's not enough deductions for the charitable contribution to be utilized. Well, you're saying after year 5 it goes away, but I gave that benefit. And not to be selfish, but part of the reason why I gave was to get a tax benefit. That's a very interesting topic that comes up potentially. That's something else that has been discussed over time, is maybe we should extend that amount over time. There's obviously limitations on that. Another interesting issue is these limits can be different for different types of taxpayers. Corporations versus individuals. They can have different limits. So make sure you keep that in mind. So this really concludes a basic discussion of the charitable contribution deduction. And I hope you understand now why it's viewed as a sacred cow through history and why it is so important. But being so important, it has lots and lots of abuse with lots and lots of rules we have to go through, lots of hoops we have to go through to make sure that potentially a client or even ourselves can actually utilize it.